Hey everyone! I'm just getting this thing up and running. We had a little bit of a technical error a little bit earlier, so I had to restart it. Let me know if you guys can hear this okay and if the video is okay. Let me know in the comments section. How is everything? All right, what's going on, everybody? Here for the second weekend in a row to go over basically valuing stocks. But I got a couple of things that I want to go over with you guys today. Where did I put my note sheet here? So I want to start giving you guys some good market updates, especially with everything that's changing with obviously this recession, the pandemic, things going on in the stock market, and then obviously what impacts a lot of us. For the folks who've been watching this channel and then me is the Airbnb side. So today we're going to go over the different or what we know about the stimulus plans. Then we're going to start talking about the Airbnb empires that are going bankrupt all around us and what kind of deals are going to show up for those who are ready to jump on it. But don't worry, I think that we have about 12 to 24 months before we really see deals that we want to jump on. And then we're going to start talking about the market. If you guys noticed last week, we had a huge market gains across the entire board. I'm talking about, think about the hotels, the airlines, the cruise ships. Every stock went up. Why is that? We'll talk about that. And then we're going to get into a little bit of cryptocurrency, something on this channel for those folks who've been a part of the channel. First of all, thank you very much for the support. But I never really talked about cryptocurrency. I've never been a backer of it. I didn't really believe in it. I still have my thoughts and my doubts about it, but it's starting to look a little bit more attractive. I'm going to tell you guys why. And then towards not the end, but probably 10, 15 minutes from now, we're going to dive right into the analyzing of four public companies that I'm interested in. And then also I got a couple of questions from folks just like you. And then if we have time, I'll start answering questions or even analyzing 1, 2, maybe 3 of the stocks that you guys throw out. I intend these live streams to be about an hour. Last week we went 3 hours because you guys were asking really good questions. And then you guys were pulling up companies that I was really interested in. So if you're on a computer, pull up some browsers or pull up your browser and get some tabs ready so we can go through this together. If you're on a phone or you're in a car, just sit back, relax, and hopefully you guys can interact and right into the comment section, and I'll answer your questions as quickly and as best as I can. And remember, there's about I think there's about maybe a 10-15 second lag. So what you're seeing right now, I said 10 to 15 seconds ago, and so but the chat is instantaneous, so I can respond to you directly or really fast there. So forgive me if there's a delay. Thanks, Yvette. Appreciate it. All right, so let's jump right into this. So the stimulus plan. So you guys have probably seen, not just from my channel, but a lot of the financial education channels, there's a ton of talk going around the stimulus, especially with what's going on in the government right now. And are we getting more checks? My grandmother, so I deal a lot. So if you guys, many of you guys know this, maybe some of you guys don't. I'm the primary caretaker and financial person for my grandmother. And so I take care of her, and we had to take care of her stimulus check, and she just received it. And I know a lot of people, and she's on Social Security, she's on fixed income, and I know a lot of people haven't gotten their checks yet, and they're coming. If you guys go back and look at I think it was maybe 3 or 4 videos ago, I actually made a video of when people should be expecting their checks. The government right now is sending out 5 million checks every week, and I think they actually surpassed that last week, but there's still a lot of people who haven't gotten it yet. So just hang tight. Go look at the last video. There's a schedule based on your income, adjusted income, when you should be getting your checks if you haven't gotten it yet. But with what's going on in the Senate just got back into order last week when they started going back and having meetings and such and opening up with masks and things like that. And then they're expected this next week to actually start talking about new stimulus plans. What we know is that Democrats are really pushing basically a UBI or a universal basic income for most, if not all, people. I believe the gap, or not the gap, the limit or the threshold right now is at $100,000, $75,000 to $100,000. Everybody below that will get somewhere between $1,000 to $2,000 a month is the most popular stimulus package among the Democrats. Obviously, the Republicans have a very different view of it, and they're kind of holding off on it right now. If you guys know anything about the difference between Democrats and the Republicans, very broadly speaking, is that the Democrats usually want to help the people, and then Republicans tend to lean more towards small businesses, big businesses, that type of thing, less government. And so what they're leaning more towards is like updating infrastructure, supporting jobs, businesses, that type of thing, payroll, and not directly the individuals. So they're going back and forth, but what it sounds like between Mitch McConnell, the Trump's U.S. economic advisor, and even Trump himself, is they are absolutely looking at a new stimulus. What that entails, we're not entirely sure yet. So we're going to have to hang tight on. Hopefully we'll get more news next week, but it definitely sounds there's no stimulus. If you had to ask me what I think is going to happen, is I think that it's really dependent on how well the country opens up. Right now, there's basically a giant blank check for our country. If you guys don't know what's going on, the Federal Reserve and basically administration has basically pulled all gloves off, and they're basically, we'll print all money, send out all the loans. Basically, there's an unlimited amount of money right now to stop our economy from crashing, which I'll get into in the market here in a little bit. But yeah, so I think that what most likely is going to happen is they're going to hang back and see what happens in the next 2 weeks, 3 weeks maybe, as states start to open up, and they're going to reanalyze or reassess and see how much stimulus is needed. Do small businesses need support? Do all those 32 million people who are currently unemployed, do they need assistance? And then they'll make a decision then. But again, they don't act fast enough, it could really hurt the economy. But I think that next week we'll have more solid answers. And nobody knows. If you watch all the other YouTube channels that are talking about it, nobody knows, because the Senate and Congress doesn't even know right now. There's probably 24 different proposals in the system right now. And just because it's a proposal, by no means does it mean it's a bill or a law. So hang tight. I'll keep you guys posted. But with that said, the one that's most popular among the Democrats right now is the $2,000 a month from 6 to 12 months for everybody. Obviously, it would be adjusted, but right now, that's most popular. Roger says he can't hear me. I just did a lot of talking. Can you guys hear me? Okay. Please type in the comment section. I keep on doing this because in Zoom meetings, if you guys can hear me, I just or you guys were muted, I say thumbs up. I don't know why. It's a habit now. Can you guys hear me okay though? All right, so we'll see if anybody else is having issues. Okay, thanks, Jason. Any other questions? I'm going to keep on looking at this screen every once in a while, but obviously I want to make eye contact with you, and I've got my other screen with everything else on here. So if you guys have questions, please throw it in here. Fantastic. So Roger, it might just be your volume. Turn up your volume, maybe. Sounds like everybody else is good to go. Okay. The next thing, Airbnb. So you guys know this, is that I made most of my money, or a lot of my money, off real estate. And I got started in Airbnb or short-term rentals back in like 2008, 2009. So I was like out of the get-go. I started room share even before Airbnb in like 2007, 2008. And it wasn't because I was smart or anything like that. It was because I had no money and I just had to offset my mortgage. But I've been a part of it for a long time, and I made most of my wealth, or my income, is from real estate, both in like the appreciation of the properties themselves. When I sell the properties, I make a good income or profit off that, and then I have long-term tenants, and then I also have short-term rentals. And as you guys know, the hospitality and travel industry is getting hit super hard right now. Perhaps the hardest, and I think that we're going to see a lot of bankruptcies and a lot of bailouts. Airbnb is not immune to that. Airbnb is actually at the forefront of getting hit the hardest. And what that means is that a lot of these folks, the folks that invested a lot into Airbnb, and when I mean invest in Airbnb, I mean they bought properties, they leveraged loans, they got leases. Arbitrage is a big one that you guys have probably heard of, and built these mini empires, is what I'm hearing on the media right now, of properties strictly for Airbnb. And a lot of them are facing a lot of liquidity issues. Whenever you guys hear liquidity, it just means cash. It means money. And they're having to close up shop because they're not able to meet their lease arrangements or pay their mortgages. And that's the danger of Airbnb that I was very fortunate about. I'm gonna make a video about a little bit more detail about why I've actually been rather insulated from all this, and some of my properties are actually doing even better during all of this. But we're seeing a lot of people, and we're seeing a lot of people start claiming bankruptcy and having issues paying mortgages and leases because what they did, as you guys know, about a third of Airbnb, let me get this right, a third of Airbnb is just one property. Another third of Airbnb has between, I want to say, two to six properties, and another third is like a dozen plus properties. Those are like the big property managers, giant funds who just lease literally dozens, if not hundreds of homes and properties and list them out on Airbnb. This is the danger with any type of investment. And I learned this from the last recession, learning it again, and coming from somebody who's, I'm not saying successful, but been more successful with short-term rentals and real estate, is that you can never invest 100% and go all in on one thing, especially over a long period of time, and especially at the peak. And a lot of people that are getting caught with their hand in the cookie jar are the folks who got one Airbnb, it's like, oh, this is successful, I'm gonna go and do this again. And they use the income from their first Airbnb to leverage a mortgage or a lease into a second, into a third, into a fourth. And typically what ends up happening, or for my case, is that I have other income streams set up, or even in my case when I first started, I had a career. And my career, my paycheck or my salary was increasing. So I'd buy one property, rent it out, keep continuing my career, create more income streams. My salary would go up, get a second property, third property, fourth property, so on and so forth. And so my income went up with my Airbnb, but at any time, if my Airbnbs went away, my income can more than handle paying for the mortgages. And what happened is when you go all in on something, one thing like this right here, pandemic, or in the last recession, the mortgages and basically owning a bunch of properties that lost in my city 30, 40, 50% of your value, is it'll wipe out your net worth and it'll wipe out your liquidity or your cash flow money. And that's what we're seeing right now. And we're seeing this also in the marketplace with big companies. So it's not just individuals. And I say that to you, and I hope that you guys will understand, like, you don't ever want to invest 100% into anything. Especially for the long run. And you don't want to bank off of peak periods. And so a lot of times when you think that you can get $200 a night forever, it's not realistic. And when you leverage that across 24 properties, you're going to get bit eventually. And that's what we're seeing right now. How that relates to public companies is that a lot of public companies are doing the exact same thing. And right now, that's why we saw that huge crash in March, is a lot of people got caught with their pants down, both individuals and companies, is they didn't have a lot of cash, they over leveraged, they had a ton of debt, and once their revenue gets taken away, they're like, what do we do? And so companies like Hertz Cars, we're talking about a lot of hotels, the airlines, they have no cash because they poorly managed it and they over leveraged their companies. Okay. Tell me what your thoughts are about that. Do you guys have questions about Airbnb? Are you guys seeing any type of issues with your Airbnbs or people that you know that have rentals? Let me know in the comment section. Antoinette, sorry I messed up your name. Walker, when can you get your money? Are you talking about your stimulus check? You should check the calendar. I don't know your situation, so you have to check the calendar. If you go to the IRS portal right now, I'm not sure if that's working for you. It's really dependent if you're on Social Security or SSI or SSDI. The last time I checked, my grandmother isn't on that. She's just on Social Security. Is that her information was in there and it was updated with a date. However, the last time I checked, they said that SSI and SSDI was not up to date yet. It was not in the system. So they're lagging behind. Okay, so the market. If you guys haven't seen, and I'll pull up the, maybe I should switch over to it now, but it had a full week of rallying last week. Basically, the entire market is up about 5 or 6%. Some companies like Tesla were up like, what was it, like 12, 13% in a single week. It went from 700 after Elon Musk's tweet, from 700 all the way up to 850. I should really pull these up to let you guys know. But essentially, what's going on, I'll pull up the screen here in a little bit. But what's going on in the stock market? Why is it going up, and should you guys try to get in right now? The short answer is stocks are emotional, and it's building up off of investor confidence right now, or investor overconfidence. And that is happening because last week it was heavily swayed by many states reopening. But that does not change the fact that fundamentally that our economy is changing, or that we're in the middle of a pandemic and a recession, and economies aren't fully open yet. And we still have over 30 million people unemployed. So the quick rally is just kind of like, hey, people have high hopes, and it's emotional based. Companies are still high in debt. Companies still have super low revenues, if they have any revenues at all. For example, Disney, basically their entire cruise line park system that makes up roughly 25 to 30% of their annual income is at a zero right now. They're making no money off of a giant portion of their business. On top of it, Disney Plus, even though it has 53 million paying subscribers now, which would generate over $4 billion a year, is expected to lose $2 billion a year because it's a brand new system, and programming and managing it and still investing in it costs them money. So they're planning on making about $4 billion on the revenue from Disney Plus, but they're going to spend $6 billion just managing it and making sure that it runs properly. So we have a lot of strain within the system. So the current market rally is not justified. It's just because people think that whenever there's good news, they think things will go back to normal, and it goes up. And that's why we're seeing the overall market do like this insane increase of 5 to 6%. And we're seeing individual companies, Chipotle, Nvidia, basically any company, you can throw a dart at the entire stock market. Anything that lands on went up last week. It's not justified. The other thing behind that, though, that I wanted to add a little caveat to is that the Federal Reserve is pumping a ton of money into the system. So that could prop everything up. And this is an important thing for you guys to know, and I'll talk about this in another video too, is that whenever there's a ton of money infused into something, you create inflation. And inflation really kind of boils down to two main things. There's a third one, but the two main ones is that inflation will either increase the prices of services and goods. So imagine we went to the grocery store and your normal carton of eggs is like, say it's $2, and there's so much money in the system that now your carton of eggs is $4, right? Everything doubles. Getting a plumber to come over to your house is usually $150 minimum. Now it's $300. That's inflation from goods and services. There's just a lot of money floating in the system. The other one that we're all very familiar with is equities and assets. And so that's stock market and then home prices. So if you guys notice, since 2008, home prices across America in a lot of major cities went up 20, 30, 40, 50, sometimes 100%. That is inflation. There's a ton of money that went into certain equity or certain assets, the real estate market. That is real inflation. And so what's happening right now, if you guys watched the last live stream, is there's a ton of money, $3 trillion to be approximate, went into the stock market, raising all equities. And that's the dangerous thing, is that with all things standard, or all things held the same, is that yes, the stock market should go down because these companies are not performing as well as they should. But with $3 trillion or even $2 trillion going into the stock market, it will just make everything go up. It's dangerous. It's dangerous because it's hard to predict. And so we don't know if that's the new baseline, just like how it's very likely that if you own a home or wherever you live, the price of that value or the value of that property or home is probably not going to go back down to 2008 levels. It might dip down a little bit, but not down that far. And that's the danger with stock prices, is when they keep pumping money into it, it might create a new normal. So that's one thing that we'll talk more about, and I'll have to do a little bit more studying up and researching all that, see how that's going to impact us if the Fed keeps on pumping money into the system, which will lead into cryptocurrency in a little bit. Now, typically speaking, I say for anybody, if you guys were my friends, my family members, sisters, moms, brothers, anything like that, I'd say if you have a stock portfolio, you want to invest, no matter what's going on, 80 to 90% of it into sound companies with good financials, which I'll show you guys how to do that here in a little bit. And I'm hoping, I know this is stuff that I've learned over a decade going into my MBA program, and it looks confusing, it looks complicated, and it's really not. I promise you, if you keep coming and watching me do this or practice it and go through what I'm talking about and ask me questions, you'll get the hang of it. But you want to spend about 80 to 90% of your portfolio on sound companies with good balance sheets, good financials. Even if the stock market is going crazy for Tesla, I do not invest in Tesla outside of maybe 10 to 20% of my portfolio. And 20% is a lot. And that's because I have play money. If you have a more conservative portfolio because you're older or that you're on a fixed income or that you maybe not even have a job right now, I would say put it into mostly good or value stocks. Growth stocks, Tesla, Amazon, Netflix, Uber, Groupon, anything like that doesn't have strong backing or a strong past, just understand that you could lose your money. And a lot of companies or a lot of people have lost money speculating on stocks. And they focus on the Netflix, the Amazons, and the Teslas. But they forget that for every company like a Tesla that went from $20 to nearly $1,000 now, there's probably 20, 30 other companies that literally went bankrupt, got bought out, stocks traded sideways, stocks went down. So keep that in mind. Just keep that in mind and don't put too much money into speculative stocks or growth stocks unless you can afford it. And unless you're like 21 years old and you have a $500,000 stock portfolio and you know that you're making like $300,000 a year, yeah, dude, throw in 100 grand into Tesla. You'll make it back. You have plenty of time. If I'm 35 years old and I make $45,000 a year and I have a $30,000 stock portfolio, I would probably only invest maybe 2 to 3 grand into highly speculative stuff. Maybe 5. Okay. Let's answer these questions real quick. Okay. Zach's apps. What job did you have when you first started to invest? Zach, I started off as, what is it called? It was a company that focused in higher education. And what we did was that we consulted with universities and colleges to help students persist and graduate. And so we also partner up with the university itself because I don't know if you guys know this, there's a huge issue in the United States with students taking out a ton of loans. So whenever I talk about college and universities, this is where that experience comes in, is that there's a huge retention problem with students. And a lot of students will basically flunk out or quit school with $30,000, $40,000, $50,000, $60,000 in debt. So most of the debt crisis inside the United States with student loans is not what most people think. People think like, oh, I graduated with an engineering degree and I owe $100,000. That sucks because I start at $70,000. It's not that. The big issue is you got a lot of first generation students, minority students or refugees, immigrants and whatnot coming in, which that's not a bad thing. The bad thing is that there's no family history of a US led or Western culture education system. And they go in and they get flooded and inundated with a bunch of stuff. They take out a bunch of loans, they flunk out or they quit and they're stuck with those loans. And so what we did is we went in there and we helped give students skills, and then we consulted the school or the university system or the state system on how to do a better job of retaining students and providing a better environment for them. That's what I did. And then after that, I used that to buy my first 2 properties, 2.5. And then after that, I went into consulting full-time in operations and finance, which made a lot more money. And then I was able to invest and buy more stocks and more properties. Here's a quick fun fact. This is why I'm so interested in the stock market right now is because in 2007, 2008, I was 22 years old, 23 years old. At 22 years old, I was naive, I had a stock portfolio. I'm not joking you. If I had invested $10,000 into the exact stock portfolio that I had and I didn't sell and I bought more of what I had already purchased, I think my stock portfolio was like $1,000 back then. I had more than $10,000, but I was too nervous. I didn't know what to do. I didn't know how to analyze stocks. That stock portfolio, if I had put $10,000 in it and kept it till today, even today, despite all the dips and everything from 2009 till now, it would have been worth close to $1 million. I think about $800,000 if I had kept that $10,000 in the stock market. But I was dumb. I sold it. I used it to buy more properties, which isn't necessarily a bad thing. But I could have taken $10,000 to just shy of $800,000 in a decade. And I wouldn't have missed a loss of $10,000 in the grand scheme of things. But I would notice $800,000 more in my bank account. Asha Campbell, would you recommend paying your properties off in full? Asha, that's a great question. I would actually. I wouldn't say all of your properties. So as you guys know, this house right here, my house that we're filming this in, that you guys see in my videos, is paid off. I never actually got a mortgage on it. I would say the fast answer, quick answer, without knowing all the variables, is pay off your primary property off as soon as you can. And then if you are able to pay off rental properties, it's not a big deal. But with business and rental properties, if you can get a good term or a good loan with good terms and you have cash flows to cover it, I wouldn't worry about too much. You don't want too much of your liquid assets or your liquid funds, like your cash, paying off investment properties per se, because you could use that to leverage it to buy other things. I know I say all this after I was just talking about how other people over leveraged, but if you are able to stay within your means as a business, debt and mortgages and leases is not a bad thing. You just want to make sure that you can cover it. So, but in terms of a primary residence, absolutely, I would say pay that off. The best thing for most people is pay off where you live. If you can buy a small tiny home or something, or you buy like a cheap place or a wrecked up place for like $100,000 and you put a bunch of sweat equity in it and you can pay that off real fast, that's the best thing. The best thing that I found for myself, that I give advice to a lot of the students or the clients that I coach, is that you want to live a premium lifestyle at almost $0. And so as you guys know, is that I live basically off of like $950 a month. But I have, everything I have. I have a Tesla in the garage. I have my house paid off, and I can vacation, or not vacation anymore, but I can do all that stuff. And it's just because I dropped everything. I got rid of my expenses. And housing is usually 30 to 50% of your expense. Good question. Okay. Bees Nuts 22. Do you know if you can have both unemployment PUA and sign on the IDL grant? You know what? I am not 100% sure on that. I'll be honest with you. I think my knee jerk would be like, yes, that the paycheck program, I think that's a paycheck program, right? I might be wrong. Is that you can do both, because one is for the business and then one is to protect your own paycheck or your lost income. But I would definitely look into that. I'm not sure. Sorry. All right, last thing, let's get into Bitcoin or cryptocurrency, and then let's start analyzing some companies. If you guys have ideas or you guys have companies that you guys want me to look at, or you guys have questions about specific things about the stock market or Airbnb or anything specific, throw it into the comment section here and I'll get to it. Cryptocurrency. As you guys know, I was not a huge fan of them for a long time, especially when Bitcoin was hitting $20,000 back, a year or two ago. I knew that wasn't sustainable. I threw out a lot of shade at Bitcoin. But now cryptocurrency is actually not looking like a bad thing. I don't think it's the answer. I don't think let me take that back. I don't think Bitcoin or Ethereum or Ripple are the exact answer. I do believe that something in the form of cryptocurrency is going to be more of the answer than the dollar or the yen or anything like that, or the pound, or like any type of government-backed currency that we currently have. And the reason behind that is because exactly what the Fed is doing right now is they're just printing money. They're printing digital money and they're manipulating the market. And what ends up happening is that they can manipulate it in a way where it's favorable to whomever's manipulating, whoever's pulling the lever, whatever they want. It might not be good for you and I. And so with Bitcoin or cryptocurrency, it's a set established system. Bitcoin is nice because you know and you can see how much is created, and you just can't go out there and create 1 trillion Bitcoins tomorrow. You can do that with the US dollar, and it messes with the system. It messes with everything. And you inflate things that shouldn't be inflated, and you deflate things that shouldn't be deflated. And you've seen that happen in a lot of different countries, and it causes a lot of bad stuff. And when you team that up with politicians, individuals, people with other agendas, it's just a disaster. And so I really do think that cryptocurrency is more of the right thing. Now, in regards of as an investment, okay, here's the thing. If you are okay and able to lose $8,000 to $10,000 over the next 2 decades, this is what I would suggest. I'm going to be doing this, okay? It's called asymmetrical risk. Asymmetrical risk means the down or asymmetrical, if you guys don't know what that means, you guys probably do, is that one side is so high, the upside is so high, and the downside is super low. Or vice versa. It can be the upside is so low, but the downside is so high, right? Like if I said, hey, why don't you invest $1 million into my business and I might be able to give you a $5,000 return. And you're like, no, that's not worth it. I could lose $1 million for $5,000. But if I said, hey, give me $5,000, I might be able to give you $1 million. You're like, okay, what are the odds? Now, if I told you 50-50 odds, would you take it? Right, you probably would. You would risk $5,000 for 50-50 chance of making $1 million. And that's how I see Bitcoin, is that there's a good chance over the next 20 years that cryptocurrency takes off and Bitcoin is the standard, and that the I think it's an $8,000 investment today could turn into $100, $500, $1 million plus in 15, 20, 30 years, right? There's also a very, very good chance that it goes down to zero, or it does nothing, or it trades sideways, or just continues to go up and down. But the thing is that I'm okay over a 20-year period to have zero with the potential of having $1 million. And it's an asymmetrical risk. I don't know much about Bitcoin. This is something that I'm personally going to be looking a lot more into, and I'm going to be researching a lot more. But from everything that I've read and everything that I know about Bitcoin, and everything I know about the US dollar and just government-backed currencies in general, this is looking very justified to have something that can't be manipulated or easily manipulated. Okay. Armed Cadaver, yeah. Hey, Armed Cadaver, have you ever heard of Vooks.com? It looks like you make you're a children's book illustrator. I have a friend that runs this company that makes animated. They take children's books and they animate it, and it's really taken off, especially during this pandemic. But yeah, Airbnb just released 1,900 of their employees, so it's 25% of their entire workforce. Airbnb is getting slaughtered. They're gonna make less than half of what they made in 2019. It's mind-boggling to think that a company of that size, of that magnitude, could lose more than half. Let's say it's 55. Let's say it's 60% of their revenue. Imagine if you make $50,000 a year, and then like that, I guess that's a bad example because a lot of people they went to zero. But imagine if they're like, hey, you can keep working for us, but we're gonna pay you only $25,000 next year. You'd be like, wait, what? Why? And how do you survive? You've got these bills, you've got utilities, you've got rent, mortgage, you've got kids, all this stuff. And so Airbnb is in the same situation. So they had to let go a lot of people. They did have, I'll give this to Airbnb though. They did give them a really decent severance package. I believe that they gave them 14 weeks of pay plus an additional week of pay for every year that they're at Airbnb. It's very generous. Another good thing about Airbnb, to give you some idea of, I don't think they're going to go anywhere. I think they're going to be just fine. I think Brian, I always forget his last name, Brian, the founder and CEO, he's got a good team around him. They went out and just raised $2 billion in money. But here's the thing: if you guys know about how equities work and how equity is done when you raise money, is that it's based off the valuation. They were valued at 31 or 32 billion just in 2017. When they went out and raised the $2 billion, they were only valued at 18 billion, which means that the companies or the investment firms that gave Airbnb that $2 billion, they took like 12% of the company. They just gave up 12% of their company to secure this cash so they could survive this pandemic. And so, but the nice thing behind it is that we saw a lot of big names put money into that $2 billion to invest in Airbnb. So that's a good sign. It wasn't like one shot, like little tiny nobodies. It was big hedge funds and big investors who invest in Airbnb. That's a very good sign that they believe in the business. So I don't think Airbnb is going anywhere. I do think that this pandemic is wiping away a lot of the muck and a lot of the, not to tease or not to be mean to anybody, but a lot of the inexperienced, younger house hackers that over leverage themselves, or the people that thought that they could make a lot of money. And I don't want to say exploited the system, but they over leveraged themselves. They went too far and above their means. And hopefully it will leave a lot more of the legit or the more sound property owners and hosts who can provide a better and more stable experience for Airbnb guests in the foreseeable future. But we'll see. Okay, let's jump into some business here. I gotta switch this screen up so you guys can see my screen. Do you guys have any questions? Any suggestions on types of businesses that you guys would like to see or hear, or see analysts or me analyze? Let me get this out of here. Close this. Hang tight, folks. I just want to make sure I can share the screen with you and not block anything. All right, we'll throw this down in the corner. Boom, boom, boom. All right. Excellent. Okay. So the first companies that we're going to do is, and as I'm doing this, if you guys have questions or suggestions, please let me know. Real quick, it's just if you guys see, Bitcoin is currently trading at 8,500. Not too bad. Let me just see. And then the market last week. Look at this. 5% gain over, 5 days. So insane. After a bunch of companies just released earnings that were negative, and they're basically saying, we don't know when this is going to go back to normal. We still had to lay off a bunch of people. We're going to be cutting our profits by 30, 40, 50, 60, 70%. And then the market goes up. It's so insane what's going on right now. It's, by the way, I'm not a financial advisor. I have to throw this out there because you guys gotta remember, when I talk about stuff, sometimes just inside my head, I'm thinking in terms of me. I'm thinking about my portfolio and what I would buy, or what you guys might see my portfolio here in a little bit, which you guys definitely will. And I want you guys to remember that what I'm doing, it may be a very different or completely wrong answer for you. And it might be too risky for you. It might be too conservative for you. But a lot of the things that I want to do is, like, I want to share this with you so you can think about it and you can decide. But don't just take what I'm saying as, oh yeah, definitely go buy. Oh yeah, definitely sell it, or definitely hold on it. I just want you guys, I want to give you guys information so that you guys can use it and make your own decision, okay? I don't want you guys to think that I'm telling you to go out there and do something specifically. All right, so the three companies that we're going to look at today are Caterpillar. If you guys don't know what Caterpillar is, you guys have probably seen it driving down the road. Basically, every construction site, those big bulldozers, cranes. Do they make cranes? No. The any type of earth-moving machine. Caterpillar has it. So we're going to take a look at Caterpillar. The second one we're looking at is Planet Fitness. If you guys don't know this, it's a more economical, basically 24 fitness style type of gym that has very basic workout equipment. And I'm personally a member of them. I went to them because it's actually, or I go to them. They're all closed down right now, but they're actually really, really nice for $10 a month. It's way better than paying $40 at a 24-hour fitness. That 400% premium to go to a 24-hour fitness, or the 600% premium to go to an LA fitness, it's not, those gyms aren't 4 to 6 times better. I just need some weights. I want some cardio machines. I want a place to do pull-ups and dips, and I can do it at Planet Fitness. 3 is DocuSign, something that I've really touted about before, and I wish that I had known that they were, I think I knew that they were public, but it didn't really sink in, is I use DocuSign all the time for all of my agreements, all of my contracts, and they seem like a very reasonable company to look into. The only thing I can tell you right now is they're probably not a value company, so we're not going to be able to value them very accurately, but we'll give it a shot. I'll show you how I look at companies, both valued and growth stocks. And the last one is Lowe's. You guys know I love Home Depot. I have a partner, not a partnership, but I am a pro member or contractor with Home Depot. I use them for most, if not all of my projects in some capacity. And I've probably done maybe 2% of my business with Lowe's. And every time I go to Lowe's, though, they've been really nice, super professional. They usually have exactly the same thing that Home Depot has. But let's see if we can value them and see if we can get a good deal on Lowe's during this whole pandemic. Okay. Let's see. Bees Nuts 22. Which stocks did you pull out 10K that would have made you millions? What stocks can I invest 10K now and profit in 10 years? Man, that's a big question. So let me see if I remember. The stocks that I had back in 2008, 2009, it was definitely Tesla. I bought a couple of shares of Tesla. It was like at $17 a share. I bought Wachovia Bank, which went under, got bought out by Wells Fargo, which Wells Fargo was another one I've invested in. JP Morgan, what was that? The Bank of America I had. Nvidia, Activision, Starbucks, and there was 2 others that's not coming to the top of my mind right now. Yeah, I had 2 others, but the big ones that really did really well. Oh, AMD. AMD was another one. I can't think of it. Activision, Tesla. But Tesla, Nvidia, and Activisions were the big one. And I think I had maybe a couple in GM and Ford and stuff that didn't really do much. But it was the Nvidia and Tesla and Chipotle. Those were the big ones. Okay, so let's jump into Caterpillar. So as I'm going through this, you're going to see me just kind of get weird Rain Man type of stuff. I'm not saying I'm smart like Rain Man, but I'm just going to start running through numbers. If you guys get confused, ask me questions. We're going to start with Caterpillar. I like to use Morningstar. I'm going to move my mic here just a little bit so it's out of the way. I use Morningstar to pull all my financials. Okay. I created a spreadsheet right over here. Let me get this size correctly so you guys can still see and I can still do my thing. So my first thing is I'm going to set up a new template. Move copy. I'm going to change this to Caterpillar. And I always put the date down here. Oops. So I know what time or what day I analyze the company. Come up here. You guys can see I just did AT&T. And then first things first is I go through here. This is my sheet where I analyze everything. So you got company name. Don't ignore these right now. These are all the wrong numbers. It'll tell me what the price per share is valued at based off my valuations. And then it'll tell me if it's undervalued, overvalued. And then this market discount rate is basically currently right now, what is the market value or how much is the market discounting that company? And you guys remember a discount rate is basically how risky is that company. So basically 0% is there's literally zero risk. You could put your money in there and you're absolutely 100% guaranteed your money. The closest thing to this is like a treasury bond, okay? That's the closest thing to a 0% risk. But even that has a little bit of a risk. If you did it in like Venezuela or Greece or something like that, it's gonna be a very like 20, 30% risk. But typically with most companies, it's floats around 5% is very standard. Very low risk for a company is 2 to 3%. You start getting into 10%, you're starting talking about a little bit higher risk. And the risk is not about the company going bankrupt. The risk that we're talking about is how likely are they going to be able to produce the projected revenue and profits from whatever your sheet is doing. So that's all it is the discount rate is how risky is it that this company will not make the revenue that you project. And so when you guys hear that in the market, that's what it is. And this discount rate, all it is the inverse of the current PE ratio. So if you guys have heard in the stock market, price to earnings, PE ratio, everybody talks about PE ratio, every single person will talk. All it is the risk rate that the market is applying to the company. And how you get that is you put 1 divided by the PE ratio. So in this case, it's just 1 divided by 15.2, which gives us 6.5%. So the market is giving them a relatively, not super high, it's very average risk rate. Okay. So we're going to go in here and we are going to start analyzing the stocks for CAT. So I need to put in a couple of assumptions first. So the current stock price, I'm going to jump right over to Caterpillar. Let's get in here. I'm sorry if I talk a lot, you guys. Sometimes I just ramble. I apologize. Let me get this so I can see both screens. All right, so current stock price is $112.11. Current PE ratio. This is all on Morningstar. It's completely free for you guys. I highly recommend it. So I went over to valuation, price to earnings, current 11.84, so not too high. And so you guys gotta remember, in the last 2 recessions, or any recession, when there's a contraction in the economy, construction goes down. And so that's why we're seeing, if you look at here, it has relatively high PE ratio, right? God, 108. That's like Amazon, Netflix level. That's insane. And then it slowly dips down to normal. The market average is about 15x. So this is trading below market value. All right, so the market is giving a little bit higher of a discount rate or risk rate. Let's see how much cash they have. So for cash, we go over financials. And this is all in billions, okay? So we don't want to put a bunch of zeros everywhere and get confused. So that's why we do that. All right, I'm going to have to scroll over here. Or no, I'm going to have to make this bigger so I can see. There you go. All right, so you go to the balance sheet for cash. We go right here. Cash and cash equivalents, 8.28. Actually, you know what? That was for 2019. We're going to pull the number for the most current so we have a more accurate price, okay? Or more accurate valuation. So they have 7.12 in cash, 7.12. We're going to look at how much debt they have right here, just above it. Total debt, 37.09 billion. So right off the bat, if I told you I have $10,000 in cash and I have $50,000 in debt, you know, you would understand like that's not a great situation, right? But it depends on the terms of that debt. Is it interest free and I don't have to pay it back for 30 years, or is it at 20% interest rate and it's due tomorrow? Those are very different scenarios. So that's where we have to dig a little bit deeper. But you guys can understand the difference between having $10,000 in cash and $50,000 in debt. Same thing for this company. It's just more zeros. They have $7 billion in cash, but they have $37 billion in debt. We just need to figure out when that debt is due and how much they're paying for it. Okay, outstanding shares. This is the number of shares that they have out in the marketplace that we can buy. Okay, this is really what dictates price per share, and we have to make sure that this is very accurate, the best we can. And so this is another site that I use. It's called Simply Wall Street, and it just has a great company information that can offset Robinhood, Morningstar, and it helps me confirm a lot of stuff. So right here, I'm just going to do really quick. I'm going to do shares outstanding, and then I double check it because it's so important by the number of shares that are in a company when we do valuation. I want to make sure that the number is somewhat accurate. And the reason behind that, and we can talk about this more if you guys want me to ramble, is companies can influence and mess with their stocks. or the number of shares by either doing something called buybacks, where they buy and take away shares from the market. It's very similar to inflating and deflating currency, like what the government is doing with money. Or they distribute, they put more shares out, they flood the market with shares to raise more money for themselves. So Caterpillar could, in theory, say, I'm going to create one more share and sell it to you. Give me $112. And you're like, okay, here's $112. Give me the share. Now Caterpillar just created a share out of thin air and made $112. Now imagine if they did that a billion times. So it's showing 541.24 million. Let's go back over here. I'm going to go back to quote, short interest. Yep. So it's very accurate. 541.24. So we'll take that and we'll put it right in here. 541.24. Hey, what's up, Big Up Penguin? Yeah, I was just talking about it a little bit earlier in the live stream. My Airbnb's actually been doing really great. We had to convert 3 of them to long-term or longer term. One is long-term, 12 months. One of them we had a guest in there for the last 2 months. Basically, we made a very slight profit, like literally like $50 profit a month, but that was fine. We just want to cover our nut. And then the other one, we have a long-term renter moving in today, actually, and they're going to be there till August. So, but overall, it's doing just fine. That one's, we're making about $1,000 profit on that one. Remember, these are fully furnished. They don't pay any of the utilities, so we cover everything. And so, but other ones like the shipping container home is doing very well. Actually, I saw an actual uptick. The other home in a little bit like outside of the metro area, that one's doing just fine. But we didn't over leverage ourselves. I didn't over leverage myself. We had a mix between owning, mortgages, leases, and management. So we had all 4. We didn't, and I didn't put all my eggs in one bucket. So we did have to cancel one contract with somebody, but that was less to do with the pandemic and more had to do with, it was just a really, really crappy client that we just had to get rid of. So, okay, let's get back into this here. Tax rate, we're going to have to calculate that in a little bit. So ignore this 18.8. Again, it's off old information. Average interest on debt, I'll get into that a little bit. Now here's the fun stuff. So this is where I have to put in my my education, my background, my experience to make an educated guess. So I have to come up with a discount rate for this company, and I have to come up with a multiple. And what the multiple is basically seeing how far out into the future can I assume that this company will continue generating income after my projections. So for example, right here, we go down here, you guys can see that I projected this out to 2024. This multiple is basically saying how many more years after I project can I assume that that company can at least maintain that revenue level, okay? This is all very basic, very standard way of value investing. This is what Warren Buffett does. This is what MBA schools teach you, whether it's Harvard, Stanford. This is how it's done. And the brilliant minds like Warren Buffett will literally go and sit down with the CEO and ask them and like figure things out and then run this calculation. Whereas you and I, we have to run off of financials, news articles, earnings statements, that type of thing. So ours will be a little bit less accurate than Warren Buffett's, but you guys will get the idea. Okay, so for Caterpillar, right now, right off the bat, they are a very well-established company. They do have a ton of debt, and they do have relatively low cash, but they are well-established in our industry. They have a ton of machinery. We'll see how much machinery they actually have here in a little bit. I'm going to give them a standard discount rate, remember, is like 4 or 5%. I would say actually 7% is actually not that bad. You can see the market's giving them an 8%. I'm going to give them a 7%. In the construction industry, we've only used, when I did heavy civil stuff, we used, all I saw was Caterpillar stuff, and then this Japanese brand, I forget, it starts with a K. For the EBITDA multiple, the standard for a publicly traded company is 8 times. This one was 7. I would say for Caterpillar, I'm going to give them the standard. All right. Now let's get into the fun stuff. Let's start running some numbers. So now we have our assumptions in. You guys will start seeing these numbers start changing as I update their financials. So when it comes to financials, there's 3 main ones. I've talked about this before. You guys probably know this. Don't get bogged down and confused by all this stuff, okay? This stuff is more for folks who are like high level, not even high level. It's for people to just get a quick glance of what's going on in the statements down here. Ignore it for now. What we really want is there's 3 statements. There's an income statement, which basically just tracks the profits and losses of a company. How much revenue did you create? And then how much did it cost you to create that revenue? And then you have the balance sheet. This is basically what do you own and what do you owe? So like liabilities and assets, right? That's all the balance sheet is. It's like how many cars do you have? How many houses do you have? And then how much debt do you have on all of that? That's essentially what it is. And then cash flow is how much cash is flowing through each part of your business. So you have an operating part, you have a financing part, and then you have an investing part. How much cash is going through that? And so if you know that, you can just, where to jump to find the story behind the company. So right now we're going to start with income statement. And all I'm going to do is I'm going to export it to Excel. Open it. And it looks like this. Boom, boom. And then if I did this right, I am going to copy paste it into my spreadsheet here, where it should automatically pull into here. And you can immediately see that it already messed up and it's throwing an error, which we'll go back there and fix it. We'll fix it here in a little bit. But let me make sure that it actually pasted it correctly. I'm going to try one more time. Boom. Boom. So I'll delete that. That's from the old one. And I'm just going to do this for each of the statements. So now I'll do the balance sheet. I'll export this. Pull this over here. Scroll down. Copy. And then I'm going to scroll over here. I'm going to paste it in here. And if you guys are familiar with Excel, all it is I'm just creating basic formulas to pull this information into my spreadsheet. And then sometimes I have to go back and fix it. And the reason why I have to fix it is companies all have different types of accountants, and they have different systems of labeling things. So sometimes the labels and where they put the numbers I need, they kind of, I don't want to say they bury it, but it's in different parts of the financials. So I just have to hunt it down. But this will give me the vast majority. All right. Good deal. No. Let's open this back up. Okay, so now that we have all that in there, now we need to start figuring out where this is. So I'm usually pulling from right here. Depreciation is just, depreciation and amortization is a really basic thing. It's basically if you buy, okay, here, I have my iPad right here. I paid $300, $400 for this, brand new, but we know that's not worth $300, $400 right now. I bought it, let's say a year ago. If I sold this to you, I'd probably sell it to you for like $200. That means I lost 50% of the value. For tax purposes and understanding that in business context is I have to track that I just lost $200 over the course of 1 year by buying this, this iPad, right? So people do that too, or companies do that too, when they're thinking about you have to buy a giant piece of machinery that costs you $15 million. Every single year you use that machine, you can't resell it for $15 million. Maybe it goes down to $13 million, then $11 million, and then $9 million, and then they sell it at $5 million. That's what depreciation is, and it's really important because for companies like Caterpillar that has a lot of machinery and they build this stuff, they probably have high levels of depreciation. Now I just have to find where they put the depreciation A lot of times it's in the income statement, but like I said, companies will not always do the same practice as everybody else. So you have to be able to find it. And I bet you I know where it is. It's always going to be in the statement of cash flows. So this is the statement of cash flows. And right here, boom, I'll highlight it, is depreciation. And so you can see, relatively speaking, I mean, depreciation is pretty high. Start at 3 billion, and then it tapers down to 2.6 billion. So what I'm going to do here is just ignore the confusing mess here that I'm doing, but I'm just setting up my formula so that my spreadsheet will pull the numbers from the statement of cash flows instead of AE, AK, instead of over here. So if I go over here, AK. And so I'm just messing with my formula. There we go. Oh shoot, I'm gonna have to do this all over again. That was 6. I'm sure a lot of you out there are actually really good at Excel, and it's probably really tough watching me, whoopsie, bumble my way through this. What did I mess up? That's what I messed up. In grad school, there were like these geniuses with Excel, like savants, like they just do anything and everything. I'm just like hunting, pecking, bumbling my way through it. Embarrassing. Okay. So once we get the numbers all in, let's see, principal. So I'm just looking for the errors in my formula, and then we'll dig into the numbers here and we'll see what's going on. So I got another error here for the principal payments of short-term loans. I know that's also in the statement of cash flows. And you just do this enough that you realize you know where everything is. And I know right away this is what I'm looking for. But I'm looking for... See, and this is part of being we call it being a financial detective, is that you just try to find things. So right now I'm trying to figure out how much they paid and their short-term debt, because that's just important. Just like if I ask you, it's like, hey, how much did you pay for your credit card debt last month? And I'm trying to analyze you. That's what I'm basically trying to figure out with Caterpillar, is I'm trying to figure out, hey, how much did you pay in your short-term debt? But they tied two numbers together here. They did the issuance and repayment of short-term debt. They combined it. So let's say that you paid $100 last month for the credit card, but you also spent $500. You put those two numbers together, it's $400. But if you don't tell me that you took out $500, you paid off $100, I don't know those numbers. All I see is the $400, and that's what we see right here. All we see is the $3 billion. All we see is the $140 million. And so I'm like, okay, did you pay off anything, or did you just take out $3 billion in short-term debt, which is a ton of debt for short-term. Short-term is typically like 12 months and less. Short-term debt can be a little bit more, maybe 12 to 36 months. Any accountants out there, help correct me, but I think that's pretty sure. And then long-term debt is obviously anything longer than that. This might be just 12 months or less. That's a ton of debt that they pulled. So I do not see, man, they didn't break it up for us. That is really, oh, right here. Oh no, that's just for, okay, so you see how they broke this up right here? I'll highlight it so you guys can see it. Proceeds from issuance of long-term debt. So that's how much long-term debt they pulled out. This is how much debt they paid off. So great example right here is they took out a new loan for $5.1 billion. That same year they pulled out that new loan, they paid off an old debt of $8.3 billion. Okay? And what they most likely did is they had $3 billion, but they didn't have the other 5, so they took out a new loan to pay off the old loan. Right? So you can just between those two numbers and what they are, obviously, is that you can generate a story. It's like, I knew that they only had $3 billion in cash. and they had to pay off this. They had to service a loan that was going out. It was becoming due, and so they had to refinance or create a new loan. But they did not do that with short-term debt, which is very, very not fun. And they pulled out more debt last year. This is 2019, yeah. So what we'll do for that right now is I'm going to zero that out, and I'll have to dig into it. And we'll just have to keep that in mind while we're doing this. So I'll do this and 0. Okay, now we can get into some of the stuff here that we can do. So let's assume that all this stuff right here is based off of their financials. Okay, I pulled it off. And when we value a company, what you're trying to do is you want to get rid of all the fluff, all the crazy accounting, engineering that they do, the ninjas when they manipulate numbers. What we're trying to understand as value investors when I invest inside a company, a value stock, is operationally at the fundamental level, how well can they do? So when I'm talking to you, for example, I'm like, fundamentally, how well can you, let's pick on somebody here. How well can you, Asha, can you create basically savings, create money for your household, right? I don't care about that stick of gum that you bought. I don't care about your coffee per se. I don't care about that extra side gig that you did one time that somebody paid you $100. On the baseline of your career, the baseline of your mortgage, your utilities, your grocery bill, the essentials, how much can you normally make or save? That's the same thing for a company. The company has their versions of one-off expenses or one-off income streams. We don't care about that, but it's captured inside the income statement when a company's like, yeah, we just sold a piece of machinery for $20 million. And you're like, but you don't do that every year. You do that once every maybe 6 or 7 years. He's like, oh yeah, we had that one client that came in and paid us a bunch of money for this one project that one time. He's like, well, that's not consistent. And so what we're trying to do is we're trying to find that, the essentials of their business. And it's actually really easy. It makes it way easier for us as value investors. And so that's all I did is I dumbed down and I simplified their financial statements from hundreds of lines, 300 lines to basically 20 lines that I need of numbers. And so basically it's the revenue that they created, they brought in, how much it cost them to make that revenue, their SG&A, which is basically sales, general, and administrative. So think about salaries, the marketing department, everything behind the scenes. And then the depreciation of their equipment and machinery, the taxes they paid, and then CapEx, which is capital expenditures, like them buying new property, buying new machines, that type of thing. Working capital, which is, I talked a little bit about it before, which can be very confusing, but think about like inventory, accounts receivable, accounts payable, which are basically just IOUs, right? Accounts receivable is when a company sells an item, like say a bulldozer, and they're like, hey, don't worry, you don't have to pay me right now, pay me in 45 days. That's accounts receivable. I am going to receive money in 45 days. Accounts payable is the exact opposite. I hire you to come and install something at my factory. You tell me, it's like, hey, you don't have to pay me for 45 days. I'm like, awesome, but I still have to pay you. So I have to pay you 45 days from now. I have an accounts payable. Make sense? Change in working capital is just those basically 3 things and how much that goes up and down. Okay, it's like this second bank account. And then obviously we have our debt that we just have to do, or we have to figure out. And the 2 main lines that we're looking at for any company is unlevered free cash flows to the firm and then free cash flows to equity. Free cash flows to the firm mean it's unlevered, meaning that you don't care about debt. Operationally, without debt, how well or how strong is this company? And that's what we base companies' valuations off of. So for you, for example, let's say that you have a mortgage, you have a car loan, and then let's say that you have like some small credit card loans too, or credit card debt, and then student debt. Let's say you have all that. I want to know how well you function without those debt. If I took away those debt, how much would you be saving? And you'd be like, dude, I'd be saving a ton of money. And then I'm like, great, that's what I'm gonna base it off of. I'm gonna base it off your salary and your normal expenses outside of debt. But I'm also going to check your health by seeing, okay, now let's add in the debt. Let's see how healthy you are. That's essentially what we're doing. That's unlevered free cash flow. Whoops. Unlevered free cash flow is I take away the debt just to see fundamentally how healthy you are. And then I add in all the debt, and then I see fundamentally how healthy are you if I added back in all the debt. Okay? You want to see those two numbers just so you can gauge where they're at. All right. So we're doing that with Caterpillar, and then I start looking for inconsistencies. And how you do this is I look at my common sizing, which is basically I divide everything against the revenues. Okay? And when I divide it against revenues, it gives me a percentage of revenue. So everything is equal in a sense. And so you can see, just as an example, I know I'm doing a lot of talking here. We'll go through the next ones a lot faster, but I want to make sure that you guys get this, is that the cost of goods sold up here for the years 2016 or 2015 to 2019 range from 73% to 69%. You can see the last 3 years, it got very, very, very consistent. Right in this 69.5. Oh, I guess it got 69 to 69.5% of the revenue was cost of goods sold. Right? When you start talking about billions, hundreds of billions of dollars over the course of 3 years, it's actually pretty accurate to us to see that a company falls within 1 point of it every single year. So you can keep doing that. SG&A, it looks like it floated around. You can actually see it going down. So I can tell a story right here. I can see that it's dropped from, in 2016, it was at 12%, and it dropped down to almost 9.5%. That's 2.5%. They dropped their cost of doing business from SG&A. 2.5% of $53 billion is a lot of money. Rough math in my head, $1.5 billion. They wiped off of it. That's good management, right? They reduced their costs. And then right here is just taxes. And this is the really confusing one that I know a lot of people get kind of mixed up on, is you can see that the taxes that they paid is all over the board, right? 1 year they're at 7%, another year they're at 2%, and then they jump up to 29%, and then the last 2 years they float around 12%. This is because every single year with a new administration, new tax laws, different accountants, different tax strategies, the accountants will do what is best for the company. And there's a lot of write-offs. There's certain years where you can buy something or do something and you get certain write-offs. And so it can be all over the board, but typically what I like to do is I take the median, okay? So I'll take the median of the last 5 years and I'll project it out. In this case, my formula shows that at right under 12% or 11.88%. And I'll extract that out. It's hard for us to see what they're gonna pay, but we want a baseline in there so we can basically forecast out the company, okay? Taxes is one of those illusionary things. It's tough for us to figure out because we're not accountants and we don't know what they're engineering inside the company. So we'll just take the median from the last 5 years, which in this case is 11.88. Okay, if you guys have any questions on that, let me know. What up, Gen F? Okay, now that I know the common size, these percentages, we can start making assumptions and guess up here for the next 5 years, right? I don't want to say guessing, but we're forecasting is a better word. So we're gonna forecast out. So let's look at their growth rates real quick. I'm sorry, I completely forgot. We need to take care of their debt here. So let's go over here. I'm gonna look at long-term debt real fast. This is super important. I'm so silly for not doing this earlier. So I'm gonna go over the balance sheet and I need to look at their long-term debt, which is boom, right here. And I also need to see how much they have in short-term debt. We know they have short-term debt. So we know that they have current portion. And I'll explain this to you guys here in a second. I just need to hunt out their short-term debt. Do you guys see it? Am I just not seeing it? Current debt? Yeah, that's short-term. Okay. All right. This is a little bit thing that's confusing that I hate about business is that they have multiple terms for the same thing. Current debt is basically the same thing as short-term debt. So like what I was saying before, whenever you see the word current, it means within the next 12 months. So all that short-term debt, what I said earlier about 12 to 36 months, it's actually 12 months because they're calling it current debt on their balance statement. So you can see that they owe from these years, this is how much they owe within 12 months, okay? Current portion of long-term debt is the same thing. It's how much do they owe from their long-term debt. So I might have a piece of loan that's structured very differently, and I owe 5.8 billion of that 24.5 billion this year or the next 12 months. And so that's the current portion of my long-term debt. And then this is the rest of my long-term debt that is 12 months plus out. Does that make sense? If that doesn't make sense, let me know. All right, so let's bring this back over to our long-term debt. So let's start with 2015. This is just like hunting and pecking. So excuse me while I do this. So 25.7 billion in the first year. 22.75 second. 23.4. 24.54 and 26.3. And then we're going to do the same thing for short-term debt or their current debt. Is basically we got to add these numbers together here. So we'll do, gosh, they got a ton of debt. So we'll have to add these two. Let's see what's the fastest way. This is probably the fastest way. We'll do this. We'll do boop plus this divided by a billion. 1, 2, 3, 1, 2, 3, 1, 2, 3. And then I'm just have to basically copy and paste this, run it across, and then I'll take this. I know this is not super exciting, you guys. I'm sorry. But it has to be done. Two more. Last one. Okay, now we got that in there. Now we can go through this and make our hypothesis and run it out. So we look at their growth rate. Look at this. 2019, we did not have a recession yet. Okay, 2019 was a booming, and look, they went from growing at 18%, 18%, over 20%. Negative 1.7%. Okay? 2019, a lot of us were talking about a contraction, and there's something that went on this year that caused them to go from basically growing at nearly 20% year over year to all of a sudden reducing their revenue. So they either lost a big contract or the whole market was easing up. Now, if we saw that happening before the pandemic, before basically everything stopped, we can assume that they're going to be losing money this next year. Now, I haven't dove into their earnings calls yet. I didn't listen to what they're expecting from after Q1 or any type of updates. This is me flying blind into this. I'm going to make some assumptions. Let's just say that we think that the market is going to decrease by 15%. I don't know why I was playing with that one. I gotta go up here. 15% the first year. I'll then decline again another, let's say 10%, or let's say 12% the next year, and then it's going to slowly recover. Now remember, when it recovers, it's going to recover a lot faster, okay? So let's say that in 2 years, things get back to normal, or start moving back to normal, and it jumps up 20% again, and then it jumps up 25%, and then 25% again, and then what we see is down here, right? So 2020, they'll probably lose quite a bit of money, not lose money, but they will see a significant decline again, And then it starts going back up. And then by 2023, we basically get back on pace from where we were 5 years ago, right? And then they'll probably see another big boost because they're going to grow like crazy again when the market's back in full action, trying to build up all these properties, all this stuff. Make sense? Okay. And then we need to, let's see, right here, all we did was took the median of these last 5 years, which is 69.72. I feel pretty confident with that. Okay, and all that is multiplying this by this, which gives us their gross profits. And then SG&A is doing the same thing. SG&A is assuming 11.06. Let's just make sure that that's okay. This is where I'm going to enter in, and I'm going to mess with the the calculations. So this was taking a median of SG&A. I don't think that's going to be accurate. I think it's a better form or a better number is going to go off of what they were doing. And we know that they're probably going to be doing some layoffs and reducing expenses. So I'm going to say it's going to be negative 0.095% over the foreseeable future. Whoops. And then let's go to depreciation. Depreciation, they're usually around, they've been actually reducing it year over year. So I'm going to go in here again. I'm going to mess with this. I'm going to say, let's stick with where they're at. Let's do negative 4.8. And then we're going to go down to CapEx. Let's see how much they're spending roughly each year on CapEx. They're kind of all over the board. It's under 2%. For the last, or under 2% the last 3 years. So let's be conservative and let's do 1% right here. Working capital, let's see, working capital has been negative the last 3 years. All over the board. I think that's fine. We do negative 2.94. Let's be a little bit more conservative than that. I'm going to do negative 2. Gen A and Gen F are both in here. Gen A, I've been streaming for a while. My goodness. It's already been an hour and a half. Oh my gosh, who's still here? 18 of you are still in here with me? You guys are rock stars. Man, I have just been yakking it up, haven't I? Okay. To catch you guys up, if you guys just jumped in, I talked about in the very beginning of this video, if you guys want to kind of rewind and listen to it, I went over like the market, updates on stimulus money, what's going on with Airbnb, the crazy uptick in the market that we saw last week, and cryptocurrency. And that I think that actually it's a asymmetrical risk and something that I'll be looking deeper into because the downside is I lose $8,000. The upside in 20 years, I could make $100, $500, $1 million. We don't know. The thing that I do know is that the way that the government and the Federal Reserve can manipulate currency is not going to be the standard for much longer. The markets won't allow it. Other countries won't like it. And we're going to be moving towards cryptocurrency. That's what we talked about. And then I've been babbling on about analyzing Caterpillar for the last hour, apparently. So we're analyzing the stock Caterpillar. I've got 3 more. We'll see if I can bust those out super fast and not talk so much. But right now we're working through the debt. Caterpillar right now is looking not too great because they're in the construction field or construction industry. Well, they're in the machinery industry that services or supplies the construction industry. So they're tied together. Okay, so going back here real quick, right away, the cash flows, remember the number, if we took away your debt and just looked at how much money you can make without debt, they're looking pretty strong. Even a dip in income or in revenue last year. Let's see, why is that? And I gotta check my math here. That's why, is depreciation. This is off. That should not. This needs to be plus. Sorry, you guys. Fixing my formulas on the go. Okay, you subtracted the depreciation there. You add it back in here. Boom, boom, boom. and then add it back in, subtract it out. So they went there, boom, working capital. So working capital is really going to be, that's tough. We'd have to dig in a lot deeper to give a more accurate sense, but let's say that's fairly fair. Shouldn't have too much of impact. So we see that they're positive, which is a very good thing. Let's see, they do have a ton of debt, so let's see how their debt's gonna work. Let's look at their interest payments. They're paying roughly 1.6%, 1.65, not bad. Again, I'm conservative. I'm gonna put 1.7. And then we're gonna forecast out their debt. Let's see, they've been slowly growing their debt over the years. Whoops. So I'm going to say that they are, I'm just going to type straight in here. Let's say that they stick it. I think they're not going to be growing it very much. Nope, that's not true, because this year, if they're out, they're not cash flow positive. See, you guys, this is what I'm analyzing. This is what I'm looking at right now that scares me. As you guys see this, operationally, they make good money, right? What's the thing that you guys noticed, though, that I was talking about earlier? You add in debt, they're not cash flow positive. They're losing money each and every year because they have to service their debt. This doesn't even include their principal payments that they didn't include inside their financial sheets. And so usually right here, this is when I stop looking at a company, to be honest, but we'll continue through, we'll hammer through this, is that without even including their principal payments or short-term debt, they are already negative. Hey, Gen A. I love that there's a Gen A and a Gen F, and they spell their names the same. I'm not sharing this document yet. I'm still working on it. Like, I just found a mistake in it that I just fixed. So when I get it all fixed up and I feel more confident with it, I'll share it with you guys, okay? I don't want to give you guys something that's half-baked or that's still cumbersome. It's hard for me to use sometimes, and I know it'll be super difficult for you guys to use. So, but once I get it all cleaned up, I'll send it out to you guys. Okay, so they're negative right here. Let's keep on hammering through this. I'm going to make an assumption on the long-term debt. Let's see what their growth rate is of the debt. Let's do that. That's probably a better way of doing it. So what I'm doing right now is I'm just going to calculate the growth rate of their debt real fast. This minus that. Right. Percent. So they're growing at roughly, let's say that they're growing at 6%. So I'm just going to take 6%. All right. That's all I'm going to do. And I'm going to take 6%, and I'm going to say this times 1 plus this. Boom, boom. There you go. Pull that around. What's going on here? This one. Boom. 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 Okay. Now let's do the same thing for short term. Short term looks like it's actually going down. Short term's all over the board. This is why I don't like debt, you guys. You guys watch my videos. I always talk about debt. It's even more painful for companies because right now the ones that have a ton of debt, they are hurting bad. Okay, so let's say short term, they're gonna have to grow it. Let's see, they grew it. All right, we'll do this. 0.06. Forgot a 0. So now what I'm doing, and you guys remember, this is what I'm doing right now is I'm by no means would I call myself an expert, but essentially you guys are seeing how people, when they value stocks, like, and I'll show you guys here. Actually, I'll show you this real quick. Kind of take a quick break from this way more complicated company than I thought. So when you guys do this, I don't want to look at it right now, but it'll give you an idea. So if you guys go to Robinhood, I have the gold account, okay? And this is one of my, I'll use this for my channel, and I'll use this as one of my portfolios to show you the examples. And I'm gonna start doing more videos of live trading of what I do. So I just deposited some money in here recently. What am I looking at? Cat or Pillar. And so you guys will see me doing more stuff through Robinhood. So you guys all see this? You go scroll down here. Obviously you can see all the basic stuff here. Go down, go down, go down, go down. Boom. You guys see this fair value right here? All you gotta do is somebody did the exact same thing that I'm doing here. You guys go back over here, you go to valuation. Do you see these values, this fair value? 201. I shouldn't have looked at that because I don't want it to anchor me when I'm doing my numbers. But what that's telling you is this analyst assumed that it's gonna cost him $148 a share. This analyst is doing 201, right? We are doing the exact same thing, but I promise you what they're doing is very similar or almost identical to what we're doing. The only reason why their numbers are different is they're making different assumptions here. Actually, they're making different assumptions here, and they're making different assumptions right here. That's it. And so if I met with them, I was like, hey, what'd you assume for your EBITDA multiple? And they're like, oh, I did 9. I'm like, why'd you do 9? I did 8. They're like, oh, we did 9 because of X, Y, Z. I was like, oh, I did 8 because of A, B, C. It's like, what'd you do for their assumed interest rate for their short-term debt or their long-term debt? And they're like, oh, we did 2% because we know it's ballooning up. It's like, oh, I did 1.7 because I was forecasting off the past. Does that make sense? And so this is pretty much the exact guidelines that we use to value a company based off of future earnings. There's different methodologies, different techniques. This is the one for value investing. And so this is what I'm doing. I'm trying to figure out how much debt they have so we can kind of forecast out. But it's not super essential because we already know that they're going to be losing money each month. I'm just going to do it for you guys. This is all you really need. This and this is what you need to value the company. But let me just do this because now this is just bugging me. This takes me too much longer. I'll do it later and we'll update it. So we'll do principal payments is going to be this. Boom. Copy. So we're going to look at how much their principal payments are of. So it's fairly consistent. So you guys see right here what they're paying in principal. They're paying roughly 30% each year. 31. Let's say 31.5. So let's just forecast that out, that they pay roughly 31.5% each year going forward of their long-term debt. We don't know what their short-term debt is, but right away, do you guys see the problem? I don't need to factor in short-term debt to know that they're gonna have issues. They're pulling out. They're continually operating in the negative. And so that makes me nervous about Caterpillar. However, their core business seems like it's a rocking and it's a rolling. So let's see what the valuation of the company is. We come up here. Did something break? What did I mess up here? Current stock price per share. Forecasted it out. IFV is 121. Oh, my bad. Remember, guys, I said that this was in billions. I accidentally said 541 billion shares. That's why it has to be accurate, right? So it's 54124 million shares. There you go. 167.85. So right now it's currently undervalued. I'm not telling you to buy it, okay? But based off of my assumptions is I'm saying that this stock is worth $167.85. Right now, it's currently trading at $112. Now, the big reason behind this is because we believe that Caterpillar is a strong company and it's going to take a huge hit the next 2 years, but then it's going to jump right back to normal, okay? And that's why it's valued so high. Now, I do all of this, and then immediately what I do is I look at my assumptions. I play with them a little bit, right? So I'm like, okay, let's give them a little bit higher discount rate because they're kind of risky with all that debt. So I jump this up to 9%. EBITDA multiple, let's say that, you know what? Maybe an 8 is the industry standard. Let's give them 7. They do have a ton of debt. And so now they're at 131. And I'll just play with the range a little bit to see. So right now I know that my range is, let's say they do better than normal. Let's say I put this at 6%. I go down here, I give them 9. They're at 200, all right? Now I know my range is like right around 140 to 200. And then, but when I narrow in, I was like, you know what? But I really think the discount rate is fair. It's more at 7. I'm gonna keep this at 8. All right, 170. That's my range, all right? You have to have a margin of error. But I know that it's not gonna be trading way below. They're not valued at like $50 and they're not valued at like $500, all right? So now that's what I did when I kind of jumped ahead. I'm saying if I had a gun to my head, I'd say this company is fair valued between 160 to 170. I jump over here. These analysts, and I believe they take it from multiple analysts. Let's see, they took this from 16 analysts. They valued it around $200. So that's the high side of my estimate, okay, or my calculations. I then jump over to Robinhood. The Robinhood folks, they did it at a fair value of 148. So closer to me, but more towards the lower end. So we can know that these analysts are a little bit more conservative, whereas the folks over at these 16 analysts, were a little bit more bullish, right? They're a little bit more, not free thinking, but more of a, what's it called? They're more optimistic about the company. Now, with that said, we got to dig in a little bit deeper. I'm not going to do it now, but I would start reading up on Caterpillar's annual statements. And again, I tell you this all the time, it's so easy to find this stuff. They have to make this public and they have to make it easy to find because they were a publicly traded company. If you need information on a company, if you don't want to go Morningstar or any of these sites that I use, go in, type in name of company, investor relations. They will have all the documents, all the reports, everything that you need. Read through them. I like to use this right here. I'll show you as an example. I like Robinhood Gold. I am not sponsored by them at all. I'm still on their trial membership thing. It gives you the full report of an analyst that just talks about the company. And I'll just read through this. I'm not going to take this as the word of God because this is just one analyst. But it helps shape a story. And then I'll go read another analyst or I'll go read the annual report. And so this will tell me like both what bulls are saying, which are people who are really optimistic, and then what the bears are saying, who are basically people who are pessimistic about the company. And then it'll basically give you the broad strokes or broad sweeps of what's going on with inside the company, the strategy and outlook, the quick note from the analyst, what he's noticing or what she's noticing. And then it'll go through like the different aspects of that company, okay? And then this is the great thing too when I dig a little bit deeper is it tells me how they created or how they got to the fair value of the company. So look, they actually went from 148 to 156. We're basically in a very similar ballpark, okay? Does that make sense? Is that kind of confusing? With that all said, the thing that makes me super nervous is all this valuation, all that is fucking, I didn't mean to curse there. It's all honky-dory, okay? It's this insane operating on negative cash flows that makes me nervous. It's not sustainable, right? How long can you lose money for in your own home, right? You're just going to keep on racking up debt forever? Let's see. And we see that their debt has been growing. What was their total debt? Let's go back here real quick. I just want to see. Yeah, their total debt has been growing year over year, right? It's dipped down a little bit this quarter, but it started at, 3 years ago, it started at under 35 billion. It's close to 38 billion. So it's growing because they're working in the negative. I don't like that. So, God, it's a value stock, but I would say that unless it drops down a lot more, I probably wouldn't invest in it because I don't like the fundamentals of their business. I like how they are operating. I need to dig in and see why they have so much debt though. Actually, to tell you guys the truth, the only reason why they're negative is because they keep on having to service their debt. You guys see that? So right here, God, what are they servicing? So, see, this is where we start digging. Now we're becoming like a Sherlock Holmes of their finances. Now I'm digging in to see like what they're spending that money on because they should have extra money. Because their cash flow wise, Look at that. Did I figure it out? No, I didn't figure it out. I kind of did. Not really, though. Who's still here? 16 of you are still here with me? Okay. I'm going to give you another insider secret, okay? For the 16 of you guys who are still here. Companies will do something that's really, really sneaky. It's really kind of messed up, too, okay? It's called buybacks. And if you guys don't know what this is something that's been a huge thing because the government just gave basically companies freaking a couple $100 billion, if not a couple $1 trillion. Is that you're not allowed to buy back your own stock. And the reason why you can't buy back your own stock is that you artificially inflate your company. So let's say, a really quick example, let's say that I have a Kai Incorporated, and you guys, all 16 of you guys and gals, own a share. Okay, so 16 of you, I have 16 shares. You guys each have a share. Each one is worth $100. Okay. Now let's say that I spend money and I buy back 8 of those shares. I spend $800. I'm like, hey, why don't you guys? I'm gonna buy it back from you. Here's $100. I'm gonna take it back. I take it back. There's only 8 shares now out in the market, right? Only 8 of you have it. Your share price technically just doubled. Does that make sense? Because it was worth, with 16 of you all with $100 shares, it's $1,600. I took away 8 of them. There's only 8 of them out there. Now, technically, each one of your shares is worth not $100 anymore. It's now worth $200. Do you see what's happening? Has nothing to do with my business. All I did was I manipulated and I played with the numbers. I played with the number of shares. Do you see this right here? It went from 0.58, 0.59, 0.6. So that means they're sending out more shares. Now look at this. 0.58, 0.5 is actually 0.54, right? They are buying back shares in the hundreds of millions. That takes debt. That takes cash, right? How much does that? I mean, let's run some really, really rough math right here. So let's say they go from 0.58 to, that's 300 to points. Let's say that they bought 320 million. They're trading at, what were they trading? I'll make a guess. Okay, let's say that they're trading at 0.32 times $120. Let's say they bought back 320 million shares at $120 a share. $38 billion. Okay? So they probably bought it back, maybe even cheaper than that, but they're spending billions of dollars to buy back shares, which would account for probably a lot of this debt. Because they definitely they're not spitting off the cash flows to even fund, like, I mean, let's say that I'm way off. Let's say they bought back the shares at like, I don't know, $90. And let's say that I'm completely wrong in this and they only bought back, let's say they bought back only 150 million shares. You're still talking about 13 billion. You're talking about tens of billions of dollars that they're spending. They don't even produce that in 2 years. In 2 years, they made only $11 billion. But they're spending $13 to $40 billion in buying back shares right here. You see that? So that's funny business. That could be artificially inflating their stock prices too. So something to know. All right. Any questions about that? Okay, I lost some of you, and I don't blame you. You guys are probably exhausted and tired of hearing me. All right. So that's Caterpillar. Should I keep going with Planet Fitness, DocuSign, and Lowe's? How you guys feeling? Should I just buzz through this? Let's do it. I'm going to fly through it. I messed with this formula, so I don't want to do that one anymore. How long? Goodness gracious, hour 45. Should probably save this. Let's go move copy. The next one I'm going to do is, I find Planet Fitness very interesting. Let's do Planet Fitness. Okay, that's a gym that I use. I'm sure a lot of you maybe probably do the same thing. I'm not going to talk so much, so if you guys have questions, please chime in, and I will definitely answer your questions. Otherwise, I'm just going to head down, just work on this, and you guys can just watch me. trying to go here? Hey, Jen A, these are ones that I'm looking into, and they were viewer requests. So if you guys have a viewer request, you guys can definitely just type it in, and I'll add it on to my next one. And if you guys really want to do it, what I'm thinking, and this is just surface level, like I'm kind of flying blind and just not investing. I'm just searching these out or researching them live with you. I'm thinking about doing like super chats. If you guys do a super chat, I will actually dig into companies deeper offline, and then I'll come online and I'll have like a full analytics on it, and then I'll work it out with you guys and tell you guys what I think. Just something I've been playing around with because I've got a couple of requests, and it takes a bit of time to actually do a full analysis of everything, and then these things cost memberships to run it. So, but just something I'm toying with. Good questions, Jen. All right, what was I doing? I am doing Planet Fitness. All right, focus. I'm still on Caterpillar though. I'm losing my mind. Planet Fitness, come on. Planet Fitness. Ooh, that's a high price to earnings. Look at that. What? Jeez, 2%? They're basically saying this is a for sure thing. I don't like that. I don't like that. This is probably not even it's probably not even a growth, or not even a value stock. This is a growth stock. It's okay. We can break rules. This actually might have to be the last one. I didn't think it was going to run this late, and I have to go take care of one of my rentals. Joys of being a landlord, right? It's not bad. Simple fix. All right, cash. They have 4.44 total debt. Okay, their total debt's not too bad. Outstanding shares. They don't have that many shares. That's not bad. 0.86, 0.43. We don't know what the interest rate is. All right, so discount rate. Gosh, they're a gym. They were growing really fast. They got 2. Let's give them a 6%. Discount rate. Multiple, I'll give them 8. Come on. Income statement. Whoops. Put in their income statement right here. Hey, Jen F. Berkshire Hathaway, that's a good company. Trading at over $200,000. I will add that to the list. Berkshire is something that's always eluded me. Those big companies are tougher because they are actually, if you think about it, they're not actually doing, they have so many multiple arms of the business. If you think about it, right? They're buying up other companies, they're investing in other companies, and then how those companies do dictates the price of Berkshire Hathaway and their properties and all that other stuff that they have on top of it. So I will definitely look into Berkshire. I always bet with Warren Buffett, but keep in mind that it's not a traditional or normal business to analyze because of how they structure it. Does that make sense? How many of you are actually investing in stocks right now? Let me know in the comments. Do you guys actually, and then what platform do you guys use? Do you guys use SoFi? Do you guys use Webull? You guys like TD Ameritrade? What are you guys using? You guys are so quiet today. It's just the gens are talking to me. Look at that. It pulled it all perfectly. Yeah, Buffett is he's not a fan of crypto. You know, I love Buffett, but if you think about it, he's like he's a value stock genius, right? He got Coca-Cola, he got See's Candy, he got he had GM for a long time, GE, McDonald's. The guy's old school though. You got to admit he's old school. He still drinks like five Coke cans a day. He has an English McMuffin, and he eats See's candies and what's that? Brittle butter, the brittle butter bark or whatever. Every day. Every day. He's old school. He's made billions of dollars. I'm not taking that away from him, but he's old school. And I totally understand where he's at with cryptocurrency. I get it. He also doesn't invest in Amazon or Tesla. I get it. But I think that he's very old school. Yeah, you're right. He doesn't get it. Jenny, I haven't invested. I've used Webull a lot for their analytics. I haven't invested a lot with Webull. I have done a lot with SoFi. How do you guys like them? Did you guys use them because of my channel, or did you guys just kind of naturally stumble across that? Or across them on your own? Principal payments. Issuance. Current. Do they not have current? They don't have short term? Are you guys investing in cryptocurrency? I went to school with a quick little fun story for you guys. I went to in my MBA program. Went to school with this guy, and he was kind of a negative character, very pessimistic about a lot of stuff, and then didn't like the program. He didn't win a lot of friends through the program. Let's say that. He got involved with Ethereum from the bottom. Okay, we didn't think nobody was going to hire this guy. Nobody wanted to do business with this guy. He got into Ethereum and turned a couple $1,000s into tens of millions of dollars, and now he does talks for Ethereum. Blew our mind when we all found we had a little mini reunion a couple years ago. We're like, oh, what's he doing? What's he up to? He was like, yeah, he made like $15 million off of cryptocurrency. We're like, what? He was like, yeah, Ethereum, like you bought it at like a couple cents, and now I don't even know what they were trading at, but now it's at X dollars, and yeah, basically made a couple $1 million, tens of millions of dollars over a couple years, and now is doing talks for cryptocurrency. Insane. Opportunities all around us. Good for him. Not really good friends with him. Not friends with him at all, but good for him. Okay, so it doesn't look like they have any short-term debt, which is good, but they do have long-term debt. Okay, so Jen A, you opened it. You like Webull, just open it, haven't played with it. A bunch of other channels like Stephen Graham bringing out my old cards. Oh, nice, Gen F. Yeah, I love SoFi. I love doing the fractional shares. I still keep, I have like a couple thousand in SoFi that I use to buy fractional shares of stuff when I'm interested in a stock. And then I've been actually using, I was not a big fan of Robinhood, but now I'm using Robinhood a lot more. Webull, I still use to like, if I'm on the road or like I don't have my computer, I use that because it has so many good financial analytics in it. I can't talk and do this both at the same time. I gotta do better. Come on. Have you guys invested in stocks in the past? Or is it fairly new for you? Long-term debt. For those who are just jumping in, I am just typing in the long-term debt by year because my formula will not pull this, or I haven't been able to find the right formula to pull this correctly or accurately. I should though, right? It would save me a lot of time. Man, their debt ballooned fast. If you guys don't know, Planet Fitness grew very, very fast. And anything that grows really, really fast, naturally, normally, will have a lot of debt. Unless you're like Apple and you just have mountains of cash. And even they have debt. All right, we got that out of the way. They have no short term. Well, they do have current. Let's add that in because they do have current debt that's due. It's relatively small, but we'll add it in. 0.05. Oh, my bad. It's 0.00. 0.00. So, you know what? It's such a small amount compared to what everything else, but let's just keep doing it. One more. These ones were 0.005. This one should be 0.00. All right. Yeah, you're totally right, Jen, about the Bitcoin thing. I think I'm going to start. Do you invest in Bitcoin? Did you say you did? I did see that. By the way, I'm going to write down Berkshire so I look into that. That's actually one thing that I was going to do. You know how like in the stock things, when you sign up, we get free shares. One of my free shares one time was Berkshire Hathaway. B, not A. I wish it was A. So their operating loss, they had a profitable year last year, 2019. And a lot of that, they were just losing money because they had to service their debt. Their debt did balloon up. God, it ballooned up quite a bit, didn't it? They're growing by about $500 million the last 2 years. Let's see how their growth is going to hurt them. But let's take a closer look at the unlevered free cash flows here. So their growth rate year to year is about, man, they've been having crazy growth, right? 14%, 13%. This next year, I don't think they're going to be growing that fast. Let's say that it dips down to like, well, you know what? They are a budget. They are a budget. They are a budget gym. So they could grow because in recessions, people don't want to pay for big gym memberships. They work out at home. Let's do 5%. Okay. Let's say next year they grow 5%. Let's be more conservative. And then after that, they're going to grow really, really fast. Let's say that 15%, then 20%, 25%. All right. COGS looks good. SG&A. I don't like that. Let's do SG&A is 11.5. No PAT. Depreciation 6.44, 7.39. time. They bought a bunch more stuff, so it should be growing. CapEx. It's been 8. Let's go 8% for CapEx. Change in working capital. Working capital. They're losing money each year on it. Minus. That's growing too fast. What's going on in there? So what I'm just doing right now is, if you guys can see this unlevered free cash flow, you see how I dropped the growth rate really low, and it still goes from 170 million to almost 300 million. I'm trying to see why there's such a drastic jump, and I found it. It's because I left out a minus sign. There you go. There you go. Is DCA and staking, or those types of cryptocurrency? I'm so green and new to cryptocurrency. I have no idea. All I know is those three. I know Ripple, I know Ethereum, and I know Bitcoin. All right, so Planet Fitness I have it valued at $31 a share, which is currently overvalued by $29 because they're trading at $60 a share. Let's see if I play around with discount rates a little bit. Let's say that we drop this down to even 4%. We give them an EBITDA multiple of 10. It's still way underneath their price. Let's see what I would have to get this down to. Okay, so I would basically have to drop the discount rate down to 2% and an EBITDA multiple of like probably 11.5. Yeah, 11.75 basically, to reach their current stock price. These right here, that is the equivalent of what I would give like a company like an Apple or a Google or a big established company, not a fast growth company that's growing, that doesn't have a very super secure clientele base yet, like Planet Fitness. So I'm more at, but we're gonna compare it with other analysts. Let's see what the other analysts say. I'm gonna do this 7, 8. So I'd say they're closer to between the $30 and $40 range, okay? That's what I'm saying. Let's go over to Robinhood. Let's see what they think. So welcome everybody who just jumped in. If you guys want to rewind the video in the very beginning of the show, the live stream, I went over just basically market updates between the stimulus packages, the Airbnb empire is basically filing for bankruptcy, not being able to meet their mortgages and leases. The market, why the market gained gained huge gains like 5-6% this last week, even though nothing's really happened. Businesses are still losing money. Earnings statements are coming out, and companies like Disney are just like, we don't know when we're going to be able to reopen. And then talked about a little bit about cryptocurrency. And then the last about hour and a half, hour 15, I've been doing mostly just analyzing businesses. We did Caterpillar first, and then now we're at Planet Fitness. And Caterpillar, I was right in line with the other analysts. They're valued right around, right now, I think I got 160 to 170 is how I'm valuing them. They're currently trading at 112, so a little bit undervalued, but I'm scared about Caterpillar because they have a ton of debt and they are actually cash flow negative once you factor in debt. They are a good fundamental company though. Without the debt, they are producing cash flows, but their debt is really crippling. Planet Fitness right now, just value them at between $31 to $45, which is currently overvalued since they're trading at $60, and I'm comparing it with other analysts. So let's see what this analyst says. They They didn't even give a rating for them. Okay, so am I missing it? Estimated actual. So they even lost money. Ooh, they lost a lot of money. If you guys don't know this, they shut down all their gyms. Okay, so Robinhood did not have an analyst that did it. Let's see if they did. Let's see if they did it over here. There you go. Look at that. Ballpark. So this one was done by 15 analysts. All right. Their fair value is about $23 a share. I'm at $31 a share. So let's assume let's see how we get our price down to their level. They probably did a couple things different over here, the growth rate. But let's say that if I did 8%, oh, yeah, 8%, and then I brought this down to 6. Nope, 7. There you go. So that's a little bit closer to what other analysts are saying. I could see a higher discount rate, and I understand the EBITDA multiple of 7. It makes sense. I would still keep these. I would still keep these at 6 and 8 though, myself personally. So I'd say the fair value for Planet Fitness is about $30 a share. It looks like 16 other analysts are saying it's about $23 a share. Either way, even though that we're off between those, and I'm sure that there's a bunch of assumptions that are a little bit that we could tweak a little bit to get those numbers closer together. But remember, it's not an exact science. It's just to figure out the ballpark. And right now, it's significantly overvalued. They don't produce the cash flows for it, and their growth projections and their expense levels doesn't justify a $60 plus. And then just to show you guys how bad this can be, or not bad, but how off this is. So they're currently trading at $60 a share. Look at what they're recommending. 86% of other analysts are telling you to buy Planet Fitness. I would not. It's double its value. And that's value investing, folks. It's basically you find stocks that are severely undervalued and you look at them, watch them, wait for a good deal, so like another crash in the market, and then you buy into it. And that's value because you invest in the fundamentals of the business and the cash flows and the cash of the business. You don't invest on hype like you see. I'm not picking on these 3 companies because they're good companies, but they're only good companies right now because of they were able to kind of get through all the filters. Tesla, Amazon, and Netflix, right? They're still growth companies. They don't produce cash flows. They don't have a consistent way of producing cash flows, and they're in a ton of debt. So, but companies like Apple, O'Reilly, JP Morgan, even Marriott, Microsoft, Waste Management, Visa, Boeing, even AT&T, Disney, Home Depot, all those companies are value stocks where you can look at their cash flows and make good, wise decisions. Okay, I'm going to ask a couple of questions, answer some things, and then I'm going to let you guys go. 11 of you, 12 of you who are still on, welcome lucky number 12 who just jumped in. You're just reaching towards the end of our live stream here, but if you jump back, you'll see a bunch of talk about the market, stimulus package, Airbnb, what's going on last week with the market increase, and then cryptocurrency. And then I analyzed 2 stocks for you, Caterpillar and Planet Fitness, and you'll see exactly how I did it. And then eventually this spreadsheet, I'll make it public, or I'll let you guys have it once I get it all sorted out because I'm still fixing stuff in it. All right. So any other questions from you folks? Gotcha, Jen. Oh, okay. Okay. I should probably know that. Well, thank you so much for joining in, you guys. I'll be creating, or I'll be releasing more videos this next week. I know I don't think I'm gonna put out like 1 video this week. It's been tough. I've got a big project coming up with the weather turning around. I'm doing not a remodel, but I'm doing all new siding around the house. I'm adding a bunch of stuff, building out another shipping container house, and then I've got to take care of the rentals too. So on top of all that stuff, it's all fun, and I have it's a lot of good times doing it, especially with friends and family helping out. but it does take time. And so summertime is always the hardest time for me to stay focused in just one area, which is Airbnb. When it's raining and cold outside, not Airbnb, I'm sorry, YouTube. When it's cold and rainy outside, it's easy for me to focus on videos. But I love talking with you guys. I love being able to have folks like Jen and both A and F, and then all these other folks in here and answer any questions that you guys may have. So if you guys ever do, leave a comment on the videos, share the videos if you'd like, and then if you guys have more specific questions you guys want to ask me, you guys can get to my email address and my Instagram, all my About tab on YouTube. Hit me up on there. I've had several of you hit me up, and I really appreciate those questions and the support. Other than that, I love you all. Kai out.